Good morning. Welcome to the Australian Early Finance Briefing for Tuesday, the 8th of September. My name's Nick here in Melbourne. Picking up where we left off earlier last week, which was that there was this big whale or, big player in the US options market driving up the names of tech stocks. Basically, what was happening, they were taking enormous options positions from dealers. The dealers then have to hedge their book potentially, and they hedge that using the tech names. And because there were such volumes and it was a quiet period of year, that caused the stock price to rise further, which then caused the market to keep moving up and up, so on and so forth, in a positive feedback loop. So it's been found out that the big whale is actually SoftBank, the Japanese investment house, which made a lot of its money in Alibaba in the early days. Now, because it's been found out, the investors in SoftBank, which it's listed in Japan, did not really like the news that they're sort of moving more into this sort of speculative hedge fund-esque style investment approach, which isn't sort of, their core investment philosophy. So they've lost about 9 billion US of market value yesterday. And the book, though, the profits that have been made have actually been fairly good. So the Financial Times estimates that they're gaining about $4 billion using this strategy. So certainly nothing to sort of, lift your nose at. Now, it's interesting that, in order to do that, they've actually spent about $4 billion on option premia, and that's led to a notional exposure, Bloomberg's estimating, of $30 billion. So notional call option exposure, that is obviously a huge amount, and certainly when you're looking at sort of marginal trading, particularly at this time of year in the summer months in the US, that can be enough to drive prices up. It's interesting, the history of SoftBank. So they were the big investor in WeWork, and they were holding it, hoping it would IPO at an enormous valuation, and obviously that's since imploded, and they've ended up bailing out WeWork at a much lower valuation. They've also lost a lot of money on Uber, but they have been able to sell the US mobile phone carrier Sprint to its competitor T-Mobile US, and that's part of their strategy to sort of offload more than $40 billion US in assets. But even after that, they've still got some money for the head of the business to still spend on these sorts of speculative activities. Now, it's also worth mentioning, Bloomberg says that there's not just SoftBank doing these option trades. It's actually been well reported since May that a lot of the retail brokerage firms in the US, such as E-Trade, TD Ameritrade, Charles Schwab, have been trading record amounts of call options. And basically it's driven by people being at home with the coronavirus lockdowns. What's adding to the fuel to the fire, RBC mentions that a lot of these big tech stocks, such as Amazon's, worth over $3,000 a share. Apple's just done a split. Tesla's doing a split. And whilst equity investors can buy these fractional shares now in the US, so you can buy $1,000 worth of Tesla, for example, which is obviously less than one share. You can't do that with options. So she mentions the RBC derivatives strategist Amy Wu. It says, while investors can own fractional shares, most cannot own fractional options. After the stock splits, retail will have more accessibility trading options with previously high-priced stocks. Okay, touching on one of the more exciting parts of the Australian stock market, that's the buy now, pay later sector, the sort of Afterpay and ZipPay sector. There's so many companies, and they've gained so much in market share, with Afterpay up 1,000% since its low in March. Now, on Friday, we had Matt Comyn, the CEO of Australia's largest bank, Commonwealth Bank, make a statement to a hearing of the House of Representatives Economics Committee on the buy now, pay later sector. he mentions that he sees a lot of what that sector is doing is providing credit, and he also sees that charging up to 5% merchant fee, it's between 2 to 5% typically, that it's exceptionally high, particularly when it's competing with credit cards and EFTPOS and that, which is much, much less. He does go on to say that he's also purchased a large stake in Klarna, which is a Swedish sort of equivalent of Afterpay. He spent 300 million US on that stake. But he does say that Klarna does treat their applicants much more vigorously in terms of their credit checks. So he says they consider the entirety of the customer's capacity to pay as opposed to just accepting their application form. He also mentions that they examine customer credit files in a responsible lending style customer check. He says Afterpay does not do that. It's also worth mentioning the AFR says that ASIC is preparing a report on the sector, and that should be handed down later in the year, but ASIC has already mentioned that it is sort of criticised commitments to assess customers in a draft industry code as being too vague. And there's also a Senate committee looking at the sector as well. So it's under a lot of scrutiny, and in an area that has such frothy valuations, it does seem that there's a lot of headwinds to come later this year from a regulatory perspective. And continuing on the theme of buy now, pay later, we had an IPO on the ASX yesterday that went up 45% on its first day. That is Laybuy, Laybuy. It's another company very similar to Afterpay in terms of what it does. However, probably the main thing is it offers 6 installments as opposed to the Afterpay 4, and it's 6 weekly ones as opposed to Afterpay's fortnightly ones. Now, that's one of many companies looking to sort of IPO in Australia this year. The AFR reports that there's another company called Harmoney, Harmoney, which was started in New Zealand as a peer-to-peer lender platform. It's now running its own loan book, and it does have warehouse funding facilities from 2 of Australia's big banks. They're running a net interest margin of 11 to 12%, which is fairly healthy. Now, what is special about Harmoney, you may ask? Well, it revolves around their distribution model, so they call it. Now, it deals directly with borrowers, typically, banks and that you go through distributors, or brokers. This doesn't. So they say that their main benefit is that they extract this information, they know where their loans are actually ending up, and it feeds into its tech platform and makes them make more informed lending decisions and pricing of deals. Moving on, but still related to the BNPL sector, we have news of a new entrant in the retail stockbroking market here in Australia. Australia's quite expensive by global standards. In the US, we have Robinhood, which offers free stock trading, and that's been really popular with all the people locked at home during the pandemic. And what makes that interesting is it's not really, there's no such thing as a free lunch. What happens is Robinhood sells their order book onto high-frequency trading firms, and they can essentially front-run the order book. So, if they know there's 1 million orders for Amazon stock, they'll know, okay, go long in Amazon and scrape a little bit of money off it that way. Hence, they're able to operate as a business, Robinhood. We don't have that happening here in Australia, so the brokerages really just have to fund through their fees. Now, the main incumbent is CommSec, owned by Commonwealth Bank. They charge about $20 a trade. There's one company called Self Wealth that started up, and that's charging $9.50. But with the backing of some of the buy now, pay later investors, such as Nick Molnar of Afterpay, there's a new entrant to the market. And basically what they're going to do is charge only $5 per trade, with a minimum of investment of only just $100. The company's called Superhero, and how they are able to sort of go so low, they say it's because they're going to use a single holder identification number. So typically, I have a separate HIN for each of my trading accounts. This will just have one for everyone, and that will sort of save on apparently admin and that type of thing. So interesting there, and definitely good news for consumers and retail investors here in Australia. Moving to the markets now, about an hour after the US Open, the S&P's up, Nasdaq is down a little bit, and small cap is up the most, up 93 bips. Coming up here in Australia, we have the NAB Business Confidence Survey, which is not looking good. Otherwise, that is your update. Have a great Tuesday and see you soon.
This podcast is for investment professionals only and should not be relied upon by private investors. The podcast is provided for informational purposes only and does not constitute financial advice. The values of investments can go up or down, so you may get back less than you initially invest.